Canadian real estate sector has been one of the hottest sectors on the TSX this year. Take a look at this chart. The sector is up an impressive 23% year to date, compared to only 18% for the broader index. James Hunter, Global Infrastructure Analyst at TD Asset Management, is here to explain why the sector has done so well. James, talk us through the performance of the sector this year.
Yeah, absolutely. It's been a really good year for real estate equities. The sector's up nearly 25%, so it's been a great run and well ahead of the broader Canadian stock market. But if you look back over the last 3 years, real estate's actually been the third best sector in the TSX, delivering nearly 15% annually. And we're also experiencing a really active capital markets environment. There have been $5 billion of equity raises in 2019, a number of IPOs and takeovers. So it really hasn't been this busy and exciting for quite some time.
So explain, why is 2019 different from other years?
Well, at the end of 2018, the global economy really decelerated sharply. And that was partially a result of interest rate hikes in the US finally kicking in and slowing things down. But it's also the result of reduced business confidence and activity due to trade tensions between China and the US. So with that backdrop, bond yields in Canada fell from about 2.5% down to 1%.
And that's significant. That's a significant drop.
It is significant. And that's the yellow line on the right-hand side of the chart that I brought. Now, when interest rates inflect downward in a hurry like that, it can have a real positive impact on REIT stocks. So again, on the right-hand side, that's the green line where market values are really increasing quickly. But if you step back and look at the chart as a whole, it's clear that not all time periods are the same, and there's likely other factors involved as well.
Okay, so let's take a step back. What's driving these results?
Right, so that is the magic question. I do think there's a perception in the equity markets that real estate equities have done so well solely because of falling interest rates. And while it's true that that's going to lift valuations, it's also true that it will reduce the interest expenses for these companies. But at TD Asset Management, we think that there's other factors involved that investors underappreciate. So if we were to look at the 4 biggest REITs in Canada over the last 10 years, it'd be RioCan, H&R, Allied, and Canadian Apartment REIT. They've delivered 14% per year. And we can decompose those returns into 3 buckets. You've got cash flow growth, dividends, and valuations. So starting with cash flow growth, it averaged about 3.5% a year. And that's really a reflection of companies that are able to raise their rents and improve the occupancy rates in their buildings. So that's 1/4 of the total. So next is dividends. The average dividend yield was 5% over that period. And that's companies that are apartment buildings and offices, they collect monthly recurring cash flows and they pay them out to their shareholders. So that's 1/3 of the total return. And then the balance comes from valuations. So 10 years ago, REITs traded at 11 times cash flow.
And what are they trading at today?
Today, we're up to 19 times cash flow. And so while it is a big jump, the takeaway for me is that the majority of the return is actually from the cash flow growth and the dividends. It's not just lower interest rates that are pushing valuations higher.
And what are some of the other trends that you're seeing that's really driving a lot of attention to the sector?
Yeah, there are a number we could talk about. I think the first that I'd point to is development opportunities. So earlier I mentioned how 2019, it's been a really active year. Well, a great example of that was just last month. RioCan raised $200 million to help fund its mixed-use rental development projects at the Yonge and Sheppard and Yonge and Eglinton intersections here in Toronto. I live in the area and I can attest to the amount of construction going on. But I think what this really signals is the profitable growth opportunities that these companies have, and the market is correctly identifying these opportunities and pushing valuations higher. So the second trend I would mention is the changing mix of REITs, and it's changing for the better. So 10 years ago, retail was 40% of the market, diversified REITs were 30% of the market, residential was a little under 20%, and industrial and office were 0%. So today, 10 years later, retail is down to 30%, residential is up to 25%, and office and industrial are 10% each. So the market's become more specialized, and it's also exposed to positive trends. So if you think about population growth, that keeps apartment buildings full.
Demographics, obviously, yes.
Absolutely. And then technology, think of the number of startups that are leasing office space downtown. And even something like e-commerce, it's really good for the demand of industrial warehouses. Just lastly, the last trend I'd mention is that other parts of the market are struggling. So 10 years ago, energy and materials, that was 45% of the TSX, it was almost half. Well, today we're down to 30%, and that's because of lower and more volatile commodity prices.
So that's driving a lot of attention away from those sectors towards.
Totally, and really what it reflects is if you've got negativity in one part of the market, you can get inflows into another part of the market, and real estate's been a beneficiary of that.
Now I want to touch on valuations because you mentioned how they've come up significantly over the past few years. Where do you see valuations going forward given this outperformance? And from an investor standpoint, have I missed the boat? Can I still participate in this sector?
You know what? I don't think it's too late. And that's because these real estate assets are going to be around for decades to come. It's part of the reason why private equity and institutional investors, they're really interested in the space. It's because of the duration and the longevity of those cash flows. And then it doesn't hurt that REIT dividend yields, they're still north of 4%. So while it's true that valuations are higher today than they were in the past, we need to remember that these businesses are relatively better. They're more specialized, they're professionally managed, and they're exposed to positive trends like immigration, technology, and e-commerce. So the outlook for the sector, I think, is still quite positive.
James, thank you very much for your time.
Oh, it's my pleasure.